Believe we are live, although it's always tough to know exactly what we're doing these, giving our low technical expertise. But this is the Investing Power Hour, number 57, as we keep marching on, doing these once a week. These go live typically every Thursday at 12:30 p.m. Eastern time, so right during your lunch hour on the East Coast, or you can watch the replays on YouTube, or listen to the audio on any of your excuse me, I said Spotify, but any of your podcast players of choice, Spotify, Apple, wherever. I am joined by my co-host, as always, Ryan Henderson, and today we are talking about whatever we want, as always, but it's going to be earnings season. We got a lot of earnings this week. As I look, Ryan loaded up some nice stuff to talk about. Starbucks, Uber, Snap, which I'm already cringing thinking about that one. Match Group, and then Shopify special edition. They have their earnings plus a very surprising transaction with Flexport. I have a Bitcoin bet that maybe some people heard about that I thought was interesting. Potentially looking at some real estate platforms launching some Chat GTP stuff, or I can never say that right. GPT. I always slip it and say GTP, and then mortgage rate update along with interest rates, and then possibly some fake meat data that industry has maybe
plant-based. It's different.
Plant-based.
Fake meat is pejorative.
Are we not allowed to say that?
It's hurtful.
Yeah.
And wait, we are allowed to say that because Brett doesn't eat meat, so
yeah,
we're not slandering.
I have some good anecdotes there where I hate those products and I don't even eat the real stuff. So, but yeah, maybe we can talk about that. I think that's an interesting case study of hyped up industries if we get to that later. But Ryan, let's kick things off with you. I'll tweet out some links here and then why don't you get started?
Yeah. I guess maybe it's called Earnings Palooza this week. It's probably the most chaotic week, I think, because I'm guessing this is the week where the most companies report earnings. And so there's been a ton that I've gone through that looked pretty interesting. Some of them looked horrendous. But I'll start with the interesting one. Starbucks, great report. Starbucks comp sales were up, I want to say 11%. Here, let me pull up the document real quick.
Pricing power.
Yeah, Q2 comp store sales up 11%. Now that's what I would have thought, right? Just pure pricing power. Volume transactions were global transactions increased 6%. Average ticket increased 4%. So they're still driving pretty big volume growth. I do, and I maybe didn't look into it, but I wonder if China reopening was maybe a big boost to sales for them. But either way, I mean, it looked like good results, even good results in North America. Comp store sales were up 12% in North America. So, I mean, really good growth kind of across the board. Yeah, China comp store sales were only up 3%. So, this is not just China reopening. I will say I live next to a Starbucks in Seattle that's kind of like one of the experimental ones. They like test out a bunch of stuff that like haven't been.
The big one, right? Or no?
It's not the roastery or whatever. But it's the they have like a couple stores where they trial different products. So like the olive oil coffees and like there's a number of new breakfast items that apparently haven't been launched elsewhere. And I gotta say, it feels like Starbucks is back on the come up. And the labor issues seem to be, at least from the commentary from management and kind of just what I've read in the media, it seems like the labor issues have been maybe not resolved, but kind of slowed, or union efforts are maybe kind of dying out. Now, I will say some of that probably had to do with the union busting actions that, and they're not going to call it union busting, but I think it was union busting, actions that Howard Schultz took. So, even though Howard Schultz can't seem to find a successful successor, and
is he back? Is he back? I thought they named a new.
So they brought him back, and then
it's so confusing. It's an endless story of him coming back.
No, they they brought him back and then they named Laxman Narasimhan. I apologize if I'm mispronouncing that, as his successor. And he came over from like a consumer goods business. And they basically had this like, I think it was like a 6-month understudy role where Howard Schultz was the CEO and Laxman kind of just, it sounds like followed him around, kind of got the lay of the land for the business. So it kind of remains to be seen how he'll do. But I do think it was an interesting time to be following around Howard Schultz because you had major inflation issues, kind of, and there's always kind of uncertainty with the macro economy, but there was macro uncertainty.
every conference call since 1950. We have, well, I don't even know if they did that then. Well, in this, we had great results despite macroeconomic uncertainty. I'm sick of hearing that at every conference call. It's like your business, unprecedented
Yeah.
macro
Every day is
uncertainty.
unprecedented.
Yeah, exactly.
But he also did it at a time when they had labor issues. So kind of big labor issues, inflation problems. There were supply chain issues too. I think that they had to kind of navigate. So a period when basically they had to find a way to please all stakeholders and they did a good job. I think that's kind of an interesting time for him to be under Howard Schultz. But I will say Howard Schultz, even though he can't seem to pass the business off, when he's there, the business performs well. He was able to he cut the buyback, said they're investing in the
appease Elizabeth Warren. There you go. That's your key stakeholder.
Yeah, but I mean, within I think a year of him coming back, labor disputes have gotten better. Comp transactions or comp store sales are certainly going the right direction. The buyback is back in place, or it's stated to be back in place. So he's made employees, customers, and shareholders all happy. And the stock,
stock was down, right? Or down on the earnings, but it's been up, right? It's done pretty well.
I'm not sure, but not sure on the earnings specifically. But if I pull up performance versus the S&P 500, oh God, come on, not that one. It's been.
You want to share it, or are you just gonna describe it?
It's up basically 50%. Starbucks is up 50% in the last year, 43%, and the S&P 500 is flat. So
yeah, pretty good. The do you think the labor stuff just kind of solved itself when it seemed like so many companies were getting, because the labor market was so loose and everyone had so much freedom, and now with the Fed and kind of layoffs and stuff like that, it's getting a lot tighter. People have a lot less freedom with their job choices. And after a lot of companies introduced these pay hikes, now people are probably less nervous of angering management because they don't have a ton of flexibility to leave for these jobs. I mean, I was a company we follow, or at least I keep following, that we don't own, is Sprouts Farmers Market. And they talked about the same thing where they had labor issues a year ago, or basically not like to the same extent with the union busting stuff or the, threats to unionize, but they had, struggles to attract workers and retain them because it was so easy to leave for another job. And now that's tightening up a bit. So I wonder if that almost solved itself, and it was, Schultz can just thank Jerome Powell for that one.
Yeah, I think it's harder to find a job, I think, today. Less companies probably hiring out there.
Incrementally, yeah. Here's a question from Matthias. I always hope you're saying Matt H, who, as I know who's followed the show a long time, he has an important question for you, Ryan. Have you tried the olive oil drink? And if not, you probably should. Okay, did you like it?
I will say, going in, I was a skeptic, and because they were like bringing this tray around kind of as like samplers, and it was like a olive oil cold brew or something like that. And I know maybe people don't. Maybe listeners that are here for the investing don't care.
It sounds like a great way to up your calories with minimal taste, but whatever.
I thought the drink was delicious. I mean, and you know what? Howard Schultz went on, like, I think he was on some interview and he said, like, we have a new product that's going to completely change the game. And he's like, it's olive oil. Everyone's like, what the hell? And I got to say, it was pretty damn good.
So what are
That's the
they marketing it as? Do they say it's like healthy or just kind of cool or, a new drink or just super
I
tasty, or they just kind of threw it out to you?
I don't know because I don't think it was like I don't know. They just kind of brought it around and I tried a sampler. Um, but I I don't think they're like broadcasting it as like the healthiest alternative or something like that. I think it's more just like try this new flavor.
Interesting. All right. Let's move to the next one. What do you have for us?
Um, well, I guess before we move on, I do see, yeah, you're right. The stock dropped after earnings. So I'm wondering if something was said on the call that concerned people. But anyway, Uber, I saw you had a nice, you've done a full 180 on Uber.
Yeah, maybe we can talk about that after you go through the earnings results and how. Well, let's be clear. The income statement doesn't look great, but I like the actual underlying business seems much better than I thought it would be, and maybe we can talk about that after you go through what the results were.
I mean, I think the trends of the income statement look great, but yeah, they are
Yeah,
still
well,
not net income positive. But I think a lot of that has to do with the reserve build for their insurance business now. So,
well, it's
I mean,
real. I mean,
that's real,
that's
but
yeah.
it's I guess not on the cash flow statement.
They get a little bit of float. Yeah.
But it I mean, it looked good. Mobility bookings, which is just like the actual ride sharing platform, up 40% year over year, 43% in constant currency. Delivery bookings were only up 8%, but still, I mean, it's not bad at all. Um, Mobility seems just straight up profitable. I mean, you can kind of they do the segment adjusted EBITDA stuff, which is a little tough to like parse because it doesn't include
Yeah.
corporate costs, and the
those
corporate
are those are big.
costs are meant to serve their segments. So,
Isn't it 500 million if you're looking at right a quarter for their corporate costs?
yeah, I mean, the segment adjusted EBITDA for mobility or whatever is a billion. So
Yeah.
technically it's whatever. I think mobility would be profitable if they just cut everything, but it doesn't matter. Yeah, the record free cash flow in the quarter. I think it was like 594 million in free cash flow. Net income is basically getting there. I think it. I'm sorry, I'm kind of doing these off the top of my head, but looking here, net income was or net loss of 157 million. That's significantly improved from last year. Although they did have like a mark to market loss on a bunch of stuff, I think last year. So it looks maybe
Yeah, for them, I think
inflated.
operating income's the best. I don't even think free cash flow is good because one, they're heavy stock-based issuers, and two, the equity investments, and then three, that insurance build. From what I'm no expert on the business, but it seems like that is not really true free cash flow.
Yeah. I mean, it looks like they'll probably be profitable at some point this year, um, maybe next year, but the trends are certainly going the right direction. Um, and that's with freight basically declining really quickly. I mean, there's just a ton to like. I think at this point they built damn near a monopoly, I'd say. Lyft doesn't seem
In
to be able to
mobility,
compete. Yeah,
yeah.
yeah, Uber Eats, I think is losing to DoorDash, but still it can be a good business and can be a profitable business. I think once you layer on advertising, I mean, there's just a lot to like here, and it was one of those businesses I think where every time you use the service, you think like, gosh, this is a valuable proposition for customers, um, and it's one you like intuitively think, wow, this could be a big business, but then you look and you've just been like just some of the corporate excess, I guess, a little bit gross, but I think they're getting there. And maybe those ridiculous investments are paying off now because they've been able to outcompete some of the other people. But I would say they probably could have done that with less expenses as well. So
Yeah, I think they've raised somewhere in the neighborhood of, I don't have it off the top of my head, but I believe it's could be $40 billion, and they still they're still losing money, quote unquote. Obviously, they're generating cash, as Ryan mentioned, because of the working capital stuff in the SBC, but they're still not profitable. And just to give any numbers, I believe they're at a 3% operating loss, or excuse me, negative operating margin this quarter. And a year or two ago, they were at negative 50%. So the progress is there, and you can see how it's working. But I don't know how. Look, the business looks great to me right now, especially mobility. Delivery, TBD. We'll see how that shakes out. And yeah, it's frustrating to not see the actual profitability of each unit. You know, I think they have good pricing power within the mobility marketplace. It's a fine business. Yeah, there's regulatory risk. I don't know how I make the stock work from here. I think the market cap, when I looked at it after the report, was about $75 billion. And going through a little bit of projections on their earnings, their operating income, I could kind of come away with maybe $4 to $5 billion in operating income 3 years from now. And that gets you about, if you add back probably some taxes, although I'm guessing they have a lot of deferred tax assets, which, is fine. That's good for them. And I'm assuming you want to, I haven't done the EV calculation. This is just on the market cap. So again, we have not really fully looked at the business in a while. You get about, on that 4 to 5 billion in earnings, you get about a market multiple on an earnings multiple. So I think you got to be pretty optimistic, especially given the dilution that's going to come in, stuff like that the stock is either one, going to trade at a high earnings multiple, or two, is going to grow a lot quicker than maybe I was pricing in, like 10% growth a year, which I think on a consolidated basis is probably reasonable. But what do you think? I just think the stock's a little tough to get around at this current price.
Yeah, I think a lot of the investment community recognized the direction that profits were going a long time ago and kind of priced it in. So
A long time ago, stock was
like a year ago. I remember when we looked at it for the not so deep dive, and we kind of were uncertain as to whether or not they were going to get there. I think that's basically when it started to turn around.
I don't know. Stock's up. Year to date, it's up 50%. I feel like people are dogging it. Maybe that was just because all growth stocks were getting crushed at the end of the year, end of 2022. Let's see, over 5 years. Yeah, I guess during the bubble, it popped up to like 60. It's really followed kind of the art complex and the high growth stuff, which maybe that's an advantage because the business seems to actually be making its way to being a legitimate one and actually profitable.
Yeah, I think it's a good business. Like at this point, they've got such a big marketplace full of drivers that rely on this for like legit income. They're not, at least in their mature markets, they're not underpricing their rides anymore. I mean, it's the rides are expensive and people are still using them on a regular basis. I think it's just really influential throughout kind of North America for sure, but the world probably. And I still would not underestimate their ability to waste capital. Like I think
they have 33,000 employees, and they got to pull a Lyft. Lyft fired like 30% of their employees. They just hired too many people, right? Don't you think?
Yeah, and it they still like invest in stupid stuff, or they still buy like equity stakes. Yeah. And so that stuff isn't gone. I wouldn't expect this to be a business that returns capital to shareholders anytime soon. We do have a comment here in the chat from Neil. Says, what do you make of the Wix drop yesterday? I will just disclose this now. We are no longer shareholders of Wix. Our holdings are now up to date. Sorry, I try to update them once a month on our website, and we haven't been a shareholder for 2 or 3 months.
Yeah, found some better. Nothing changed. Well, a few things changed. Maybe we'll go over it on another episode. The price changed a bit from when we really liked it at an attractive valuation. Second, management team is showing no progress in getting rational. They kind of have the same problem as Uber, I'd say, and that is okay at a cheap enough price, but is a big headwind versus other businesses. And then third, we found some ideas we liked better. I don't know why. I checked. I don't know why it's down.
I assume Squarespace reported.
That could be good. Yeah, they
they
usually
didn't
trade.
have, and they didn't have earnings or anything like that. So I'm assuming Squarespace reported it. And they tend to, I think people call it a sympathy trade, where if Squarespace results are bad, everyone just thinks Wix's will be. I'm not seeing Wix, or I'm not seeing any results from Squarespace.
Let's just look at.
Curious what it is.
Yeah, I saw that yesterday, Neil, as well, and I couldn't figure out why, because both of them were down. Both Squarespace and Wix are down. Maybe someone got some data. Maybe there's something out there. Typically they trade a little bit in line with Shopify as well. So
Maybe that was it. Maybe
but
it was like,
Shopify is this morning, so the information wasn't out there yet. And Shopify's wasn't that good or that bad.
I'll check the news feed here. See if we got anything.
Yeah, great. Wix stock. Tweet that out. Oh yeah, check out the one on Stratosphere. Oh, 18 hours ago. Why Fiverr, Upwork, and Wix were all falling today. Oh, it's because Chegg warned about Chat GPT. Oh, interesting.
I think that's maybe a stupid reason to sell it off.
Yeah, I could see they said Fiverr, Upwork, and Wix, and I'm assuming some other stuff for online platforms, but I could see Fiverr and Upwork selling off because maybe that makes sense. You can have a lot more of that stuff automated for freelance work, but Wix, that doesn't make sense to me, at least in the short term.
I know you can have these language learning models like write code, but I think Wix provides a lot more value to small businesses than just simply.
Yeah, Wix already does a lot of that automation for you. So honestly, I think it would help them as long as they don't botch it. Yeah, let's see.
And
yeah, I guess maybe there'll be more. I mean, Chegg
is the number one when I think of businesses that are most likely to be impacted. And I know this is hindsight or whatever, to be most likely impacted by ChatGPT. Chegg's number one because at least all the use cases that I've kind of, and I'm not talking about people like toying around with it. I mean, the true use cases where it actually helps is people cheating on homework, which is Chegg's core value proposition.
Yeah.
So yeah. And you know what? We've looked at Chegg. I mean,
Chegg, if you were in college in the last 10 years, you know that Chegg is uninvestable. But
right. It's always been sort of a fragile model because it's built on something that a number of stakeholders are trying to get rid of.
It's built on a lie.
Yeah. I remember hearing someone like pitch it to me as like an online college textbook store. I was like, that's not what Chegg is.
Yeah. It's all right. It's confusing though, because the way they talk to investors, they don't explain fully
what
they do.
What are they gonna say? Like, we help kids cheat.
Yeah, exactly. All right. I think that's enough with Uber. I would be fascinated to check them out, and maybe in a year or so we can do another not so deep dive on them because that's such a dynamic company. Maybe we could do Fallen Angels or basically 2010 startups as a theme. But let's move on to the next earnings.
Wait, who's bigger today, Airbnb or Uber?
It's probably close. I know we had our bet. Uber's slightly up, at least.
Yeah, by like $1 billion.
Yeah, it's about the same. What do you buy? What?
I'd like Airbnb better.
Same. Although it's more just because Uber's more overvalued, but I think Airbnb is slightly better business. Okay. Next earnings. What do we have, Ryan?
Yeah, number of different reports to get to. Snapchat reported Snap.
I didn't look. What? How bad?
I mean, it's just a business that'll never generate money, and well, never say never, I guess. But you talk about like this feeling like a project. I mean, it feels like this is Evan Spiegel's like just little experiment lab where he just got a whole bunch of VC money and now he just throws it at whatever he wants. I mean, some of their AI stuff is like frankly pathetic. They formed an AI bot to talk to people on Snapchat, like send messages.
Are you a user still of Snapchat? Did you test this out?
I don't use it anymore, but my friends have told me, and they're like, this thing's just like creepy and weird. Like no one
Yeah.
wants it. They're building stuff that no one's asking for. Um, and I'm looking right now. I'm gonna do
And
Meta
they got
now.
dual class. This is this is a big with that dual class shareholder, or excuse me, dual class stock, where I believe, and this could have changed, Spiegel has complete control of this company, so the board is a bit powerless on whatever he wants to do.
Okay, net income over the last 8 years, 7 years, negative 500 million, negative 3.5 billion,
Do you want to
negative
share? Do you want to
2
share it
billion.
or no?
No, it's all
Maybe
right.
all right.
Basically, they've never gotten anywhere near profitability, and over the last 12 months, they've lost 1.5 billion. Sometimes I wonder, like, okay, without free capital today, how long is this business going to be around? Like, you obviously can't keep doing this.
I got
The other,
another. Or go ahead. Go ahead.
the other thing, okay, so there was a really good question on the conference call. Rich Greenfield came on and basically called them out. He said, why not scale back the AR, the augmented reality investments until you're in a better financial position? You know, obviously it feels like Meta has got the luxury of sort of walking and chewing gum. When I look at like their metaverse investment, I'm not sure you have that luxury. So how do you balance sort of what you need to do, accelerate your core business versus sort of investing in the future? Basically saying like, hey, you're not Meta. You don't print cash. You can't just treat this as your little experimental box, your incubator, because it's a public company. I
Yeah,
and they gave like this just horrid word salad answer. Um, I mean, it's a business that just has to cut expenses.
I agree. I will also give another bearish anecdote. In Latin America, WhatsApp has copied all of the core features. They have stories, and it's very popular. I'm assuming it's popular outside of North America as well, in other parts outside of North America. I think Snap is going to have a very, very hard time making inroads into new markets because WhatsApp is really trying to lock down the social messaging, kind of less broadcast social media stuff, if you want to describe it like that, for a lot of these people. I mean, when I was down there, the stories feature, which it seemed exactly like what Snapchat is, just without advertising, completely copied it. And yeah, I just don't see them growing much at all. And I think, yeah, I would be, if someone said you had to make a bet, I guess even odds, whatever, we're not gonna handicap it, that um is Snapchat gonna be around 5 years from now or not? As as the same equity or the same corporation, without going through bankruptcy, I would say I would vote no.
Yeah,
I only
I
see
agree.
this
This
getting
is
worse. I only
crazy.
see it
Look at
getting worse. I only see it
okay,
getting worse.
Snapchat's price to sales ratio in 2021 reached 40 times.
Let me you gotta share this.
Today it's 2.7 times.
Let me pull it
So,
up.
uh, yeah, I mean, multiple compressions a bitch, I guess. But yeah, it's like 95% multiple compression. God, that's crazy.
But yeah,
Wow. Yeah, over the last
let
five
me
years,
share it.
it's down 67%.
Yeah, I'm gonna share it right now. Price of sales December 20. I mean, this is not even sharing the peak. I mean, look at that change. Remember when they had the Kardashian thing with the new formatting, and then it like there was the whole panic in the investor community, which has got to be funny in like a mature investment place who was in Snapchat, and they're like talking to your PM, dude. Did you hear? They're like, why is the stock down so much? You didn't hear? The Kardashians tweeted something. That's got to be hilarious. But then what are we seeing here? Back up to 29, then 18, which is still absurd, and now below 3. I guess that shows that. I mean, that's around the market average of a sales ratio, which we talked with our friend Jim Gillies the other day. sales ratios are fairly useless, except to show over the last few years how absolutely absurd they are. Some, valuation metrics are. It's usually only useless to show how absurd something is, which in
It
Snap's case
shows,
it was.
yeah, it's completely useless unless you're trying to demonstrate how useless it truly is. It I think this business, I think Snapchat may be the number one, like, letting tech VC Silicon Valley culture dictate how you spend money. Like, that might be the best example, because this is one where there's never been a focus on minority shareholders. There's never been a focus on ever generating cash.
Yeah, I just never got the thesis on it.
I don't think it's going to
honestly.
change.
Yeah, I never got the thesis. Yeah, I agree. All right, we got a comment here from Scotland. Thanks for joining. Scotland, one of the few that always joins. He says, looking at all these tickers, I believe they're all one of them specific trust bank or whatever it was. Yeah, all the regional banks. So it would be cool if we guys could do a video or episode just talking about the banking madness. Says break it down in layman's terms. You guys do a great job about that. Whatever. Thank you. Thank you for the compliment. But I don't think we can do it this episode. We need to probably prep a little bit, but maybe we could do it next week. Could be interesting. We kind of have underplayed it a bit. Ryan did say that
all-time bad timing.
Yeah, which is fine. But we could maybe try to explain it. We're not banking analysts, but maybe the basic stuff. And I don't know. Maybe we could get someone on at some point to talk about that. What do you think, Ryan? But definitely not this week. We need notes for sure, because it's not something we follow closely.
Maybe sometime we can try to get someone better than ourselves. I would say that just in general, I think the problem is every time I say something, the situation changes, and then I look like an idiot. So
I would rather do a post-mortem when we know kind of when things have fallen where they are, because you don't know, in a week everything could totally change. I mean, Jerome Powell yesterday was like everything's sound, and then although people are overhyping this Pacific Trust Bank or whatever it is, because it's so small, but whatever.
Yeah, I think generally what's happening is most of these banks that people are concerned about, it's an asset problem. So they're concerned about the loans, or maybe not the loans, just the securities that they hold being either marked down, like they're not worth as much as they were 2 years ago, because people can get higher returns today on
or
those
the
loans.
the commercial real estate gets written down a bunch, something like that.
Yeah, so I think people are worried about that as the primary concern, but I think the big concern is that somehow the asset problem becomes a liability problem, where people get concerned about the solvency of the earnings power of the bank, and then they think deposits might flee.
Yeah, so it's a delicate situation. Again, maybe we'll talk about it in a few weeks, but we can't. Yeah, not going to talk about it today. But yeah, that's a good idea. Also, Scarlett had a question. Can Ryan elaborate on the Silicon Valley culture? Maybe. Go ahead.
It sounded. There's so much innovation going on over there. I sound like just a scummy finance guy when I say, like, oh, the gross culture in Silicon Valley. But in general, it seems like they treat the public shareholders, like the public markets, as a place to dump their losses. So the VCs give them money, say, go invest as much as you can in new employees and products, and trying to get customers on the platform at whatever cost. And basically, when you finally get to enough scale, we'll have, instead, as a public shareholder, I look at it and say, like, are you generating cash for me? They look at their liquidity event as changing the shares, giving them to someone else, which is
to the
dumping
public,
them on the public.
Yeah,
that's kind of what I think of. I mean, generally speaking, businesses that lose a bunch of money every single year shouldn't live on forever.
Yeah, that's a good way to put it. Yeah, I agree. And Here's, I think, a good example of a company that used to be like that, but switched is Airbnb, where during the pandemic, they had to really tighten down the hatches. And before that, they talked about how they were really unprofitable. They talk about great, quote unquote, unit economics. And then they would burn money in marketing, burn money on growth, hire as many employees as they could. And then during the pandemic, they had to go into panic mode when they had all these refunds coming in to try to, they had to raise some really expensive debt and then just batten down the hatches, fire a bunch of people, lower their costs. And then when they came out of that, they realized, okay, well, maybe all that hiring and expenses weren't actually that useful. We can still grow because our business model is sound, generate cash, make our employees happy that are there. There's going to be less of them. Make our VC investors happy because their valuation is going to be higher because we're generating cash as a public company, and then making the public shareholders happy as well because, again, you're actually profitable. So I think, yeah, the VCs don't. No, it's not all of them, but some of these companies, and there's a big trend that happened since 2010, is some of the companies do not value one of their key stakeholders, which are outside investors, properly. And hopefully that changes. But I think it's a key risk when you look at a company like that, like Uber, right? As a public company investment, has that culture really, can they fix that? That's how we look at it. Because we're not like, they can be run like that. We're just not going to buy the stock, if you get what I mean. Like it's not illegal, but it's just a negative for us.
I mean, I think when you're told, okay, how old was Evan Spiegel when he started the business? Like 20?
I
think when you're 20 years
in
old,
college, yeah.
I don't mean to go on the whole Scott Galloway rant, but when you're 20 years old and
Ryan is 24, so
you're told by a lot of people like how influential you are, and basically when you're not a public company, a lot of people, and you're kind of in the Silicon Valley realm and you're going out and people know who you are. I think a lot of your relevance is based on how many people work at your company, what kind of influence does your company have in the Silicon Valley community, like how many people are using the app. It's not on, like, people don't really give a shit like what your operating cash flow, your free cash flow looks like. So I think it can be easy to conflate that with actual shareholder returns, and maybe that's better for your life, better for your employees. And a company can be run like that, maybe not forever, but a company can be run like that. It's just not going to provide returns for shareholders. And so that's kind of why I avoid some of the stuff where it feels like they're deeply entrenched in that kind of ideology.
That was a big concern with us for Wix, and that was the reason why we sold. That kind of, we soured on it because they weren't really fixing that issue, even though they said they were. It was one of those watch what they're doing and not what they're saying, because they said, look, we're fixing it, we're getting rational, and it wasn't showing up.
I found this interesting.
Yeah.
I saw a tweet that I thought was interesting. It kind of reminds me of like Silicon Valley. A lot of the companies that have come out of the Valley, but it's a Buco Capital tweet, which, just for the record, I think great follow. But
he's funny. He's probably my second funniest on there. Besides, I can never say right, Kubiko. Kabuki. It's Kabuki Theater, but that's the funniest account. Buco Capital is another very, very funny anonymous account. But yeah, go ahead.
Yeah, he says lots of software companies who thought they had recurring revenue unlock do not have that revenue unlock. Lots of software companies are going to guide for second half acceleration, basically a Hail Mary that the macro improves. I feel like that's happening a lot right now, which is like growth, expect slow growth in the first 2 quarters, but we expect it to reaccelerate into the back half, which is like just a prayer.
Don't worry. When all the excess consumer savings go out the door and the businesses have to refinance and all these higher interest rates are flowing through to these businesses, don't worry, things will get better then. It's like, are you kidding me? But I should note though, for any listeners, like, what does this guy know about? I don't know the person personally. I've DM'd with him before, but this person works as I think a VP or some sort of manager within a company like in the software space. So he's deciding whether to buy these software programs, as that's kind of his evidence. And he probably talks with a lot of colleagues within the industry. So he has boots on the ground.
Yeah, I'll just read the second tweet and then I'll stop. He says, one tricky thing that businesses are going to learn the hard way, frictionless sales, that's like product-led growth, touchless purchase via website, freemium, etc., is great on the way up, gnarly on the way down. No relationship holding that contract together, no friction in, none out either. I think that's gonna prove true where it's gonna be so hard. Like customers don't care when budgets contract, like how easy it was to become a customer initially. Like they're going to get rid of that if they need to, and if you don't have a relationship kind of holding that together, or you don't provide tons of like necessity value, something that they need for their business to run, I think there's going to be a lot of churn for products like that. I mean, there's tons of software companies that are kind of like that right now. So I don't know. It just reminds me, I guess, that maybe some of the software businesses, even though they are asset light, higher margin, like I think sometimes those high gross margins can be like a reverse indicator
Of what?
that, and I mean, each business is different, but like if you have really high gross margins, it costs very little like variable expenses. If there's very little variable expenses in your business, maybe you don't have that deep of a relationship with your customers. Or, and I know it's different for every business, like consumer products, obviously very different, but I'm thinking of like, sorry to call some companies out, but the Asanas of the world, like scheduling products, stuff like, I'm trying to think of other ones.
Yeah, you had to decide, or I think the biggest question if you're an investor in these companies is you have to decide whether you are confident this is actually mission critical, if there are high switching costs, if the company decided to leave the software program, would their business take a huge hit? And if not, and if it's only more of a productivity tool or some sort of management tool that's not actually affecting their core product, then I think that's the big question I ask.
Yeah. All right. Well, we've got 15 minutes here. Anything else you want to talk about? I don't know if you have anything prepped.
I have some stuff. Do you want to talk about a fun Bitcoin story or a fun crypto story?
Sure.
Yeah, this one's funny. I don't know. I don't know how you didn't see this. It was all over
I saw the headlines.
the headlines. Okay.
The Balaji or something like that, right? Isn't
Yeah,
that his
yeah.
the guy that made the big bet?
Apologies to the guy. I don't know how to say his name. Okay. They call this is from the QZ. I'm going to be quoting a lot of stuff from here, but it says all right. There's a pseudonymous which is an anonymous, I guess, leftist Twitter account won $1 million from crypto investor Balaji. Oh gosh, I can never say your last name. Apologies for that. Over a bet on US inflation. So let's go through what this was. Let's see. How do I even describe it? Let me just share the screen here. So Medlock, who is this anonymous account, it's not the real person's name, said he'd bet anyone $1 million that the US wouldn't enter hyperinflation because during the time, I think during the middle of the March banking crisis, people are talking about hyperinflation. And then Balaji, he had been warning about the risk of hyperinflation. So I think this is, they're already debating heavily about this topic. Took him up on the bet, setting a term of 90 days. He said at first, and this got settled. Funny enough, not with a smart contract, but this got settled with lawyers later on, and they finalized how to, decide and stuff like that. He said, I will take that bet. You buy one Bitcoin, I will send 1 million USD. This is a 40-1 odds as one Bitcoin is worth $26,000 today. The term is 90 days. All we need is a mutually agreed custodian. Funny enough, a mutually agreed custodian. Well, what about that smart contract, buddy? So basically it was a bet that Bitcoin would go to $1 million in 90 days because the US was hitting hyperinflation, right? And this was in the middle of March. So it's been less than 90 days. And how do I describe this? It was a win-win for Medlock because if it was hyperinflation, then sending Balaji $1 million basically is just, it's not that much money. But if it doesn't happen, then this Balaji guy has to send him $1 million on an even odds, or basically, even payout. But Bitcoin had to go up by 40 times in 90 days. Do you see how this might be a, uneven bet? I really wish I was the one that tweeted that out, because this was the bet of a lifetime. But the funniest thing that happened is that, and maybe I should stop sharing the screen so we can just talk. Even it hasn't even been 90 days, and so the VC guy, sorry, I'm not going to be able to pronounce your name correctly, said, "All right, you won. It's over," because Bitcoin's still below, I think, 30K, and he just sent him the money. And his excuse was, "I sent them $1 million. I lost $1 million to tell the world they're printing trillions." And I just think, what is this VC brain, macro doomer brain? I mean, what's gone into these people? Because he just, I don't know. What did you think of this? Because it seemed like one of the craziest, because officially the money got sent. It actually was one of these bets that went down, and half of it went to, I think, some charity. But I mean, think about it, $500,000 in less than 90 days for one of the easiest bets you could ever make. I mean, how lucky is this guy, Medlock? I mean, congrats to him.
Yeah, and congrats to him for making sure the guy followed through. It seems like one of the dumbest bets to offer, and it was probably, just for like the purposes of like attracting eyeballs and getting more people to kind of believe in crypto. I think by saying, I think Bitcoin will hit $1 million in 3 months or something like that, he might lose $1 million, but he probably has Bitcoin holdings, or that if people cling to that or something and increase the value of Bitcoin, maybe he makes more than $1 million. So maybe it's just
let me confirm the price right now. Bitcoin price as of this recording, $28,900 USD.
I don't know how much money he has in Bitcoin, but assuming that's gone from 26 to 29, he probably made more than $1 million during that time period.
That's fair, but it's,
probably has nothing to do with his tweet, but
yeah, but the only way to productively use it is to sell the Bitcoin.
Let's talk about Shopify.
Here's a question I have though. Oh yeah, what do we have? We started a little late, so we have more than 10 minutes. But here's one question I have. Is it unethical to say that you think the economy is going to head into hyperinflation? Do you think it's unethical to say that? Because some people would argue that they want to warn about the facts, right? But I think historically, it's almost been shown that that's really, I think, immoral, because you convince people that the world's going to end, and they really destroy a lot of their wealth by making dumb bets and following a lot of these people. I'm not going to name any of the names, the doomers. They can do whatever they want. But what do you think on that? Is it unethical to say the U.S. is heading into hyperinflation?
I think it depends on who you are. Like, if some random guy does it on Twitter, I'd say who cares? Like, no one's really
if Buffett does it, that would be an immoral move by someone like him.
Yeah, I think so. Like, if you know that what you say influences people's decisions and can cause something to happen, it's like him buying any stock. Like, and frankly, I think if he buys something and the stock shoots up because he bought something and he sells it, I think that's somewhat unethical. The same way him saying, like, I think the US will hit hyperinflation, there are people that can probably speak it into existence. If Jerome Powell does it, yeah, he could probably
him or
existence.
or Yellen or something like that. Yeah. Hopefully I described that correctly. It was very hard to understand that bet. Maybe I should have made better notes.
Yeah. It was it was a stupid bet, so it was kind of hard to explain the rationale.
Yeah, because I just thought it was very funny with the way, like, good marketing. I lost $1 million to tell you they're printing trillions, and I was like, thumbs up, good for you. But yeah, let's hit Shopify. I think this is super interesting. I would love to discuss this.
Yeah, Shopify reported earnings this morning. As of we're talking on Thursday the 4th. May the 4th be with you, by the way. Yeah, they reported earnings, and I believe the earnings looked pretty good. Stock jumped like 25% this morning, so it must have been good. They announced a layoff for a fifth of their workforce. And then kind of one of the big announcements here is that they are exiting basically their logistics efforts. They're selling Shopify logistics to what's it called? Flexport, I think is the company.
Yeah.
Yeah, Flexport. And they're getting an equity stake in Flexport as well.
They already owned a stake in Flexport, so it's deepening. They love to say deepening the partnership. Ooh, so exciting.
Yeah. And okay, I love to dunk on Shopify because I think they sometimes, I don't know. To be honest, Toby Lookie's done some stuff in the past that kind of like I didn't like. I don't think him pressuring short sellers is whenever
NFT,
whenever a
yeah.
CEO calls out short sellers for like being anti like bad people, I don't really like that because I think they serve a purpose in the market. But he
NFTs,
says all this
yeah.
stuff about like side quests, and he loves to make like gaming references. He's big into gaming. And he's like, logistics was a side quest for us. And it's like, okay,
nice little side quest to burn $1 billion. Yeah.
yeah, that's a very expensive side quest for your shareholders. It's maybe a flattering term to basically say that we lost a bunch of money. But I think ultimately my takeaway from this, honestly, was that every once in a while, investors are reminded how deep Amazon's competitive advantages are.
Yeah, or how expensive it would be to copy them.
And when their primary competitor exits their logistics business, to me, it shows, okay, no one can replicate that fulfillment network.
I was seeing an article in the Wall Street Journal talking about how Flexport is now going to be a competitor to Shopify, or excuse me, Amazon. But that was totally, if you're reading some article about that, I would disagree with that because Flexport is like a marketplace where you can hop onto, Amazon's fulfillment network. But here's what I thought was interesting. And again, there's more to just these 3 points in Shopify's business. First, they decided to get rid of the logistics arm with this deal with Flexport, which is probably, maybe could be worth something over the long term because they have a big stake in Flexport. Flexport becomes a big business, whatever. It's not worth that much today. Second, they're laying off 20% of their workforce. Some of that is with the Flexport deal. And then third, they reported a maybe average earnings report with gross profit up, I believe, I don't have the number in front of me, up about 12%. So fine, coming out of there because they're lapping some of the tough COVID comps still. Today, their stock is up 24%, Ryan. And they've added, I think, trying to do some rough numbers. I'm not going to do the math in my head exactly right. Maybe $15 billion in market cap today. They've added $15 billion in market cap, currently trading at a $73 billion market cap. What are your thoughts on that? Maybe I'll pull up their valuation and see what you think.
I mean, I still love the business. Like, I still think they offer a wonderful product, but their ability to take costs or their ability to take money from their merchants, so their take rate is going to be reduced if they provide less value to them. So, and I know they still offer the easiest way to set up a shop online, but if you're not providing the logistics, that's gonna lead to take rate compression. Like if Amazon's sneaking in there with their buy with what is it? Is it the buy with Prime initiative where they can integrate that onto their Shopify website? That's more value being given to Amazon. Yeah, you've got the EV to sales up here. I mean, it still trades at a relative premium to most businesses out there.
A healthy premium. I'm seeing for the listeners here, of course, during the bubble, they were up at ridiculous kind of 60 times sales. Today, again, it's not perfect. We're just using Stratosphere here. It is EV to sales of 13.1. For reference, their margins are below, I believe, around 50% on a gross margin basis. So that it's not like they're 90% like a great software company would be. And the mark, so they're trading at what? If we divide, say they have 50% gross margins, they're trading at like 26 times gross profit. And typically, again, everything, depends how much you translate your gross profit into earnings. Shopify, I think, would be fairly low though. Typically a company will trade at about 5 to 8 times gross profit on average. So it's like, this is still like here's my concern. How big can this business get? What do you think, Ryan?
If it's just providing the online shop,
And payments, all the software basically.
yeah, but I'm saying payments is going to go to Amazon.
Oh, you think it's all gonna go there? They're still growing share. I wouldn't. I mean, yeah, that is a competitive threat. Yeah, I mean that's a threat to think about. Yeah.
Well, it's a business with a lot of operating expenses, right? They have to pay for development, CMS, and being the builder of the merchant site is a competitive world, right? There's a lot of other alternatives. Maybe they aren't as good as Shopify, but I think Wix, Squarespace, BigCommerce, even just putting up your own shop on Amazon, which obviously is not, that's not your own.
Most people do
site.
both. Yeah, most people do both.
Like that's competitive, and that means the operating expenses are probably going to be perpetual, that you have to continue to invest in those developers over time to keep having a competitive product. I don't think their ability to convert gross profit dollars to earnings is going to be that high. I would guess it's probably fairly low, like you said. So, I mean, the valuation seems a little extreme, but yeah, I do think it's a wonderful product, and I think a lot of people get fixated on that and conflate that with whether or not this is going to provide good shareholder returns. I have a hard time imagining all businesses are going to be valued on their cash flows over time. I think what's today's market cap? Some 75.
Let's say 75 billion. EV is going to be slightly different, but yeah, 75 billion.
I mean, I'm sure it can generate some cash, but it's a steep multiple.
Yeah,
props to Brad Freeman, actually, because this is one of those businesses that we identified where we said this is a really good business model. My thoughts have maybe changed a little bit over time, but we said if this gets cut in half or gets cut by 70% or something like that in 2021, maybe this would be investable. Brad did it at kind of now hindsight with earnings behind us at a wonderful price.
Yeah, and I guess he's been very smart on that. He's been trimming his stake, I believe. But we don't want to put words in his mouth. He has the stock market nerd newsletter that's completely free. He kind of covers a group of companies that he owns and some of the companies that he follows, and you can kind of see what trades he's doing in real time, which I think is interesting to follow, especially if you're interested in those stocks as well. And one of those is Shopify. Yeah, we'll have to get him back on the show sometime. He used to join us on a regular basis. We have like 1 or 2 minutes left, Ryan. I'm seeing the clock here at maybe 1 minute. Anything else before we wrap up the show today?
Match Group reported. We are Match Group shareholders.
Yeah, probably for me, it was probably in line with what I was expecting. Nothing too surprising, nothing too disappointing.
Yeah, I agree.
Kind of just like no big surprises for me. Although the stock, no one knew how to trade that stock in the days following. It was like down 2%, up 5%. No one knew how to understand the report.
Yeah, I guess it would just be like if Tinder were dying, like if Tinder's relevance were diminishing, I'm not sure I'd be able to identify it early on. Because maybe that's what's been happening. And now I think it's still as large as it was last year, but it's kind of hard to say because they don't report like the user data.
Yeah, they don't. Yeah. And it's kind of hard to tell because like how valuable is a user versus an active user, because there's some people that probably hop on there and swipe like once versus someone that's active or someone who's going to pay. Yeah, I think it's a big TBD. It's one that we'll definitely have to do a post-mortem on. I think 2 to 3 years from now, it'll be very interesting because I could see a way we're right. I could see a way we're wrong. But we do like it today. We actually did do a full show on them. What would be that? 1 month ago, 2 months ago now? That anyone that's interested in that, going through the full again, when we talk about stuff we own, we try to be as bearish as possible. We're not like, we outline all the risks there, and some of that stuff is materializing. But yeah, all around, kind of just, all right, let's get to the next quarter. Is that it?
Yeah, I agree. Yeah, I think that's running up on time. We've been streaming for 59 minutes now.
59. All right, perfect. That's going to do it for this episode. Anyone that is watching, please go live on YouTube, 12:30 p.m. Eastern time on our YouTube channel, which you can, if you're listening on the podcast, you can find in the show notes. You can also watch the replays whenever you want on YouTube, or listen to the replays on Spotify, Apple Podcasts, wherever you get your podcast. If you like listening to this show, the best way to support us is to do either one or both of these things. Give us a review on whatever podcast player you're listening on, be that Spotify or Apple Podcasts. And 2, subscribe to the free newsletter called Chit Chat Money on Substack that lets you track each of the shows. Okay, as a disclosure, we are not financial advisors. Anything we say on the show is not formal advice or recommendation. We are general partners at Arch Capital, and clients may hold securities discussed in this podcast. Thank you, everyone, for joining us this week. Matt, H, and Scotland, the core watchers, and we'll see you next time.